the brand helps to bridge the gap.
I want to go back to one of the things you said earlier in the conversation about there are two things any successful hedge fund has to do well. First is make money, generate good returns. Second is raise money. And I found it crazy how you said raising money is much harder than making money. Can you talk a bit about that?
Yeah. I would say it is, so when and I don't mean to be disparaging to folks who focus on one or the other. I'm not trying to favor one or the other, but I would say there are thousands and thousands of people in the world who have put a shingle on the door and tried to raise capital and haven't been successful. And I think your listeners, I can name countless examples of folks who've generated stellar returns and just for whatever reason have not been successful raising capital. Now you got to ask yourself that question, why? And there also have been a few players who've generated very decent returns, have done a great job of protecting risk and preserving capital, but not necessarily stellar returns. And if I compare that to some of the folks that have generated stellar returns and haven't raised money, and have raised a large share of the capital, significant amounts of capital. I think if you were to ask me, I think one of the reasons for that is the really successful firms, in my observation, have done a really good job of distinguishing between marketing, branding, and sales. So there's marketing, branding, and then there's sales. And I think oftentimes investment managers try to conflate those activities into one. So now if I define what marketing, branding versus sales is, marketing, branding is the voice. What do you want people to think about you? Why do you exist? What is your edge? When you think of Coca-Cola, Coca-Cola is not a brown liquid in a bottle. Coca-Cola is enjoyment at the Olympics. It's like sitting at the beach with your family and friends. It's hanging around your friends around a poker game. Coca-Cola is this brand, this image, something that evokes an emotional connection that you feel with it. And I'm not saying that in the investment management space, you need to be so grandiose as having this emotional connection, but there needs to be a brand. What is it that people should feel about you? What is your messaging? Why do you exist in the world? That's distinctly different than going around saying, hey, I'm a great hedge fund manager. I think you should invest in this one. Both those things are important, but what aids in the process of going around to men and women around the world, to institutions, when you walk in the room and they have some semblance of who you are before you walk in the room, what is it you stand for, what's your messaging, how you're optically different, that leads to success. So now if I look around the world, and you could probably think of examples of investment management firms that have strong brands. There's no coincidence the ones that have strong brands also manage substantial amounts of capital. That branding is critical in terms of raising capital and really being a successful investment management firm. Other businesses do it really well. I have no idea why we don't do it as well in the investment management space.
So why not? It seems like any other business, you have a product, you have customers, you have a fund, you have allocators. Why aren't more managers investing the time and resources into building brand? I guess coming on Odds on Open.
No, we're on Odds on Open talking about our brand. Yeah. I don't know the answer to that question. And I will not say folks are clearly doing it. When you think of Blackstone, you think of a brand. When you think of Bridgewater, there's certainly a brand there. You think of BlackRock, there's certainly a brand. Goldman Sachs has a brand. There's certainly firms that do a really good job of the branding. Why is it not more pervasive? I don't know.
Yeah,
it's certainly hard, right? And it's not easy by any stretch of imagination. We're Versor Investment. We're relatively, we're a mid-sized hedge fund. We're trying to develop our voice and our brand. I think the folks that know us, I hope that there is this idea that we're experts in quantitative equities and invest across asset class and have an understanding of data and technology. I hope that's coming across. But our brand is certainly not as large as some others.
What are some specific mistakes you think, from being in the industry for quite some time, what are some specific mistakes that, call it emerging managers or even mid-sized managers, make with regards to brand and their process for approaching allocators and raising money?
Yeah. I think, not to be redundant, I think mistake number one, and I can't overstate this enough, not differentiating between marketing and sales. Like,
can you give specifically the differentiation and lay that out clearly for our audience?
Yeah. So and let me take a step back. I think I think there is a fear of, if I talk about myself, I might reveal some secret, right? So the brand is my voice. If I talk about myself too much, perhaps I might reveal something I shouldn't, and a competitor might hear. And that's a legitimate concern, right? You need to protect your IP. But I think what's important, if you're starting out, or even mid-size, is that people buy stories, and true stories, but people want to hear who you are and why you exist. I think every investment manager, through whether you're fundamental or you're quantitative, you have a story about how you developed your views on a market. How you developed a view on a market. You don't need to talk about a trade. You don't need to talk about specific entry points, but how you developed a view on a market, if it's successful, that's an interesting story. Like, when we talk about, we talk about merger arbitrage, we'll talk about individual deals. Once a deal is closed, and how we came about, I gave the example of this UK industrial company and how we were overweight because we accurately predicted a competing bid. To some people, that's pretty interesting. How did you identify this? How did you forecast this ahead of time? That's an interesting story. I think telling that story, that's part of our brand. We use data and technology to make what we think are interesting bets. And, the reward is having strong returns. I think that the extent you're afraid of telling your story, because you think you're going to reveal something to the market that may hinder your ability to generate returns going forward, that might be challenging. Because, the worst thing that can happen is that you walk into a room and you meet with an allocator and they have 30 minutes, maybe they have an hour, maybe they have 90 minutes to talk to you. In that period of time, in that conversation, they might retain, if you're lucky, 20% of what you said. More likely like 10% of what you said. If you don't talk to that person again for another 3 months, in that 3-month period, they might retain 2% of what you said the first time. Now, the only touch points are that meeting number 1 and meeting number 2. How long do you think it's going to take you to get an allocation for them to understand 50% or more of what you said? That's going to be almost an impossible process. And I think that's historically how people have gone about raising capital in the investment manager space, and particularly hedge fund space, is having these one-on-one conversations where people retain 2% of whatever you said to them from meeting to meeting, and you expect them to come up with a conviction to make an allocation. The brand helps to bridge the gap. The brand helps that 10% that you articulate, the 10% that they retain in the first meeting, coupled with strong branding. Branding is a white paper. Branding is going on a podcast. Branding is developing a social media inputs. Branding is having a blog. So that 10% that you share in the first meeting, supported by a strong brand that you're feeding out in the marketplace consistently, helps to jumpstart that next allocation, the next interaction. So that 10% becomes 20%. That 20% becomes 40%. Now they have a little bit of conviction. Now they can make an allocation a lot quicker than kind of the historical 1 meeting, 2 meetings. Let's figure out where it goes.
And so you'd say most managers, they don't focus at all on the brand, the story. And I imagine, I'm even just thinking right now, you have a meeting in 1 month and I guess booked for 3 months down the road. I guess if you're telling that story and if you're publishing white papers and showing the process and how you some bets you made and how the process behind those and how you made money, I guess I'm just thinking you can send that to the allocator and and they read it because they're passionate about this stuff and they enjoy it.
Yeah.
So that's what most managers do. And I guess when you're meeting the allocators, what are some of the small things that are important to do to make them, I guess, retain more, make them feel a certain way? I guess this is broadly about how to raise money and do it well. Like, what does that look like for a mid-sized quant fund?
Yeah. I think a lot of people use buzzwords. I'm going to start off what you shouldn't do. Don't say words like uncorrelated over and over again. Don't say words like diversification all over and over again. Don't say words like, words, all these buzzwords, AI. Just don't drip all these words that everybody uses. Because if you hear these words that everybody uses, if I'm an allocator and I hear the words, oh, this other guy said the exact same words. He's 5 times as large as this person I'm talking to. The return's about the same. I'm going to allocate to this other guy because he's bigger. What I think folks should do is tell stories. Stories stick. Stories have this emotional connection. Borrow from the world of Coca-Cola. People buy Coca-Cola and they think of this brand because when I'm on the beach, I want to have this sweaty glass and I want to sit next to my loved ones enjoying my Coca-Cola, right? I want to have that feeling. Tell a story that evokes an emotional connection. Tell a story that when the person you meet goes in front of their colleagues, they can recite that story much quicker than talking about uncorrelated structure of your returns versus other asset classes, blah, 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 blah. The story is something that resonates. Stories are something that sticks. Stories are something that people remember.
Yeah, I mean, I imagine going in front of the allocator and saying equity, stat arb, AI, alternative data, all in the span of 2 sentences is not exactly a recipe for success.
The worst word is quantamental. Sorry to the quantamental.
Well, what's so bad about the word quantamental?
It doesn't mean. What does it mean? what does it mean? I appreciate that people will use quantamental, that word. I'm not quite sure what that means and how that's differentiated anyway. But people use these type of words, right?
Yeah.
And I don't mean to sound too provocative. It's like, the whitewashing of AI across everything. Just because you use ChatGPT, that's not an AI system. I mean, ChatGPT is a large language model. That is AI. But what does that mean to your investment process? How does it help you generate positive returns? If you're using ChatGPT to help you look at a research report quicker in the afternoon, okay, great. That doesn't make you different than anybody else. Everybody does that. How is that additive to your portfolio construction process? How is it additive to help you generate more alpha? That's the story. I can think of a story how perhaps using large language models allows you to leverage or access 10 times the amount of information than previous times. Okay, that's interesting. Now tell the story around how that enabled you to identify security or not, increase or decrease exposure or not. I think the case studies and stories are things that people remember.
And so at Versor, would you say the way you tell the stories is through the case studies, is through the on a podcast, and being as serious about that part of your process as you are about making money and generating returns?
Yes, absolutely. And I think both are important. We're very, very serious about serving the needs of our clients and preserving capital. A lot of our clients are, public pension plans and their constituents and the folks that invest in those type of instruments. So it's important to us on the managing capital front. But how we grow as a firm and become a successful business is really contingent upon being able to raise capital. And it's very competitive. And I think the nuance of how one is successful on the capital raising front, you have to pay attention to how you're perceived, the brand, and how that ultimately leads to potential allocators getting comfortable enough with you and your institution to write you a check. That's a hard process in a world that's extremely competitive.